Hey, everybody. Welcome to CRE Power Hour, hosted by the dynamic duo of commercial real estate, the one and only Stephanie Gillison and myself, Lisa Marie Wand. So happy to have you here today. With over 4 decades of combined industry experience, we've built, we've scaled, and we continue to conquer the real estate world. Our show is every second and fourth Wednesday at 11 a.m. Pacific, and we bring you top guests from the commercial real estate field. So tune in for the insights and stay for the success stories. This is CRE Power Hour, and today it's our pleasure to welcome Forrest Jinks. He's the CEO of Altus Equity Group. And Forrest, welcome.
Thank
So
you.
nice to have you.
By the way, when I watched some of your podcasts before, they were on recording, and I didn't notice what a great intro you guys have. I mean, how cool is that?
Pretty nice, huh?
Wait, is your favorite part? Is your favorite part that I'm the fabulous Stephanie Gillison?
Pretty impressive. And then I like the big red lips to indicate Reno. I mean, how cool.
Oh, I thought those were my lips. Oh my gosh, that's so funny. So Forrest and I have known each other for about 10 years, and we just reconnected recently. And so Forrest, why don't you tell us about how you got involved in real estate investing and about your company, just your journey to where you are today?
I'll try to do the short version because, as you know, being in real estate for as long as we have been, there's lots of twists and turns and bad days and good days. But out of college, I didn't really do much real estate classes in college, but I did take a mortgage class, and I knew that the way mortgages worked, if you had consumer debt, it would really hurt your ability to get a real estate mortgage. So, and I wanted a new truck. Coming out of college, I had a job. I needed to be cool. I needed a new truck. But if I got a new truck, I was never going to be able to buy a piece of real estate. So, literally the week between college and starting my job, I had 10 days. I found a house in Santa Rosa, California, where I had my corporate job lined up and put it in contract. But the only thing I could afford, because I was making $39,000, was a 2-bedroom, 1-bath, completely destroyed house that the lady had lived in for 40 or 50 years and was a chain smoker. And there was nicotine running down the walls. Like you could see it just like on the walls. But I could afford it. So I was fortunate coming out of college. I had a little bit of savings. I'd done some stock trading and had worked jobs during college. So I had like $10,000 saved up or something, and that was enough for the down payment. The problem is once you put all your money into buying the house, you don't have any money to fix the house.
Right.
So I was working the corporate job, 50, sometimes 60 hours a week, and then I'd go at nights and weekends and scrub the walls with TSP. And then I didn't know anything about construction. I mean, I knew literally nothing, but I learned a lot on that project, and it was so painful. Like when you don't know anything and you're learning and you have to like acknowledge every single day that you don't know what you're doing. It's really hard on your pride, especially when you're 22 years old. But I got it done, and the property came with a lot that was next door. So I sold the property, basically broke even, but got this lot free and clear. I had to go through some historic district approval, which took forever and was extraordinarily painful. And I got a house approved, had a contractor build the house, sold the house, bought 2 houses, doing all this while I had the corporate job. And a couple of years into it, I was like, you know what? It's not as painful as it was because I know what I'm doing a little bit now. And I just made more in my corporate job, in real estate, working, 30 hours a week than in my corporate job working 60 hours a week. Why don't I do this full time? So that was 2002, I guess. And I've been a full-time real estate investor ever since. Between 2002 and call it 2006, a lot of growth, mostly through partnerships. I had my money, other people would have their money. We partner and do infill development. We did office condos, conversions, retail redevelopment, different things like that. And then 2008 came. At that time, I had property in California and Omaha, Nebraska. And California property just completely imploded. You were in Reno, so I think you saw a lot of that too. And I was insolvent for many years and ended up renting a basement bedroom no carpet, just concrete, a bed, and I had a microwave. But I did have internet because I could get it from upstairs. So I at least had that going for me. Coming out of that, it's like, I am not going to do that again. We were doing a lot of, our debt was, 2 or 3 years balloon debt that was constantly rolling because these were redevelopment loans. And so, and my compensation in many cases was based on milestones around completion of the projects. So we had projects, like one big office conversion we were doing, office condo conversion. We were taking it from fee simple to office condos. We sold the first condo right when everything started to tank, but my compensation was based on like the last condo or the last 2 condos, and we never got there. So I didn't make a penny on that project that I'd worked on for 3 years, 4 years. And so coming out, it's like, we're not doing that anymore. There's no way that I want to run out of money partway through a project because my partners, get a capital call on something that has nothing to do with me, which happened. I don't want the banks to be able to say, yeah, it's a great project, but the Fed will not let us refinance. Sorry. I don't know if you guys remember, but early in the kind of 2008 process, they were not extending and pretending. They were being super strict. It was only later that they started to allow that. Well, for us, it was too late. Like, we already did all sorts of horse trading. Hey, bank, I know we owe you this. We can't sell the property. It's half completed, or it's completed, just not leased up. I'll give you these 3 properties as well. And, here's a deed in lieu. And it was brutal, really brutal. But coming out of it, we said, we're going to do it differently. Altus Equity got started with a partner, and we wanted our money committed up front. We wanted it in the bank. And so we went to more of a investor sponsor model as opposed to a true kind of a JV model that we were doing before. And we've done a lot of different products. We've done both multifamily, we've done retail, we've done some office. Generally speaking, even before the last kind of 3, post-COVID, office is not a big fan, or I'm sorry, not a big favorite of ours. For various reasons we can get into if you'd like, but we've done industrial, done multifamily, done some hospitality, a little bit of land, even some ag.
I really appreciate how open you are about the challenges that you've had on your journey of becoming an investor. And if I didn't tell people that, they would think that I looked really old for being 30. I'm 25.
When you go through something like that, you just look older. So I have to have an excuse for looking like this.
I mean, I can just picture. We've all been there in our career. That's how we become successful, is we get bumps and bruises and cracks and gray hairs.
We learn the most from failure, right?
Yes, absolutely. So based on this ride that you've had and where you are now, exactly. What are some of the key points that you'd like to share with listeners that are currently investors, or they're like ready to jump in and do that regardless of what's going on in the market? Do you have some wisdom you could share?
Oh, everybody invests differently and has different strategies, and I don't think there's a right or wrong. Over the last 3 or 4 years, apartment syndication was all the rage, and people were getting into it, and short-term debt, interest only, like it was basically housing back in 2006, but for apartments. And people made money on the ride up, right? Like, if everyone's buying tulips get more expensive. And then something happens and people realize, I just paid, $3,000 for a tulip bulb. What am I supposed to do with it? I'm supposed to grow tulips. I'm kind of out of luck. And so people made money during that time frame. And I know some people that cashed out and did really, really well. What we learned from the pain and suffering that we'd gone through was, we don't want to depend on market cycles. We want to make good investments that ride out market cycles. So we're very much long-term focused. Our debt is almost all long-term fixed rate debt. There's a lot of people in the markets dealing with some serious capital stack issues right now. And we have one of those. Like only one property across our entire portfolio has a capital stack issue. And by the way, we're going to lose our shirt on it.
Yeah.
So, you take out the capital stack and you go back to the fact we've got a loan at 2.5% for 30 more years. We've got a loan at 3.25% for 28 more years. Lots of loans in the 4s for 7, 10 more years. So our properties are doing fine. I mean, there still could be functional distress at times if vacancies go up or insurance has been a big impact on a lot of things. But generally speaking, in the current environment, the distress is not functional. It's financial because of the interest rates. Now, people that aren't able to cover their increased mortgage payment then aren't spending money on the properties maybe. And so it becomes functional. But the genesis, generally speaking, that we're seeing is financial. And we've been very, very fortunate that we were not in a hurry to get rich. And because of that, we're actually not getting hurt too bad. We do annual valuations of our portfolio, and it's not a super formal thing. We get feedback from brokers, and sometimes we have offers in hand or appraisals depending on the property. And we didn't do any new projects in the last year, actually closer to 24 months almost. And even taking into account this one project where we've lost a lot of value, our portfolio is basically just slightly up. And a lot of that is because people are valuing the debt that we have in place. Even though the broader market is going down, we get offers all the time saying, I would love to own that, 2.45% debt for the next 30 years.
You're like, I bet you would.
Yeah, exactly. I'm like, well, no, we'll sell, but we're not going to sell cheap. Definitely not.
With Forrest, with everything, the climate that is going on in lending, we talked a little bit about this before the show started. There's a lot of strong, solid property owners out there that the notes are coming due, and the banks say, no, we don't want you anymore. What is your all's outlook for 2024 as you're raising this money and what you're looking to buy? I know it's multifamily, industrial, and so forth, but how are you gauging the health of an asset in that it's something Altus Equity wants to own?
So I think that within the real estate cycles, there's time we have to look at valuations differently, or what's an attractive valuation differently within the cycle. So, for instance, if I could buy a property with 100% debt and assume a 4% loan and it's cash flowing, I would do that all day long. It's like, it's free.
Yeah.
Right. But generally speaking, that's not going to be available.
No.
Or, I mean, there are people trying to do it, but it's tough. And if we look at, to your point, financing is very, very difficult. And maybe I don't want to lock in long-term debt through a CMBS product or an agency product because I think interest rates are going to go down. Well, I have to go either bridge or bank financing, or you can do shorter-term CMBS and things, but it's pretty expensive. So we are looking, I would say, almost entirely at intrinsic value at this point. Now, intrinsic value is big for us regardless. If you look at our, we've got 7 or 8 kind of core beliefs as our investment philosophy. One of them is try to buy below replacement cost. Yeah. Now, that's funny because we also build brand new stuff. Like, well, how do those things match? Well, we were building during times of high inflation. So if we locked in a contract at one price and inflation's going up 10% a year and it's done 2 years later, we're, call it roughly 21% below replacement cost. So we don't look at it purely just from like what it is today, but there's other factors taken in. But right now you can get things really cheap in some cases. And I think we're just at the tip of the spear. I think there's going to be a quite a divergence in valuations between the properties that are financially distressed and going into functional distress, because those buyers are going to have to come in with a ton of cash or really know their way around financing. And maybe the financing is going to be really expensive, kind of like bridge debt funds or private debt. And then there's going to be the stabilized assets that will hold their values better because a lot of people don't want to do the work to restabilize an asset. They don't want to do the work and take on the risk of private debt that's only a 2-year note. If they can assume a note, they'll pay for it. If they can go straight to a HUD loan or Fannie or Freddie for multifamily, as an example, they'll pay for it. Insurance companies are still lending, and they have pretty strong rates, all things considered. So if someone has a lot of equity, they can use an insurance loan and still lock in a decent rate compared to the market. So I think there's going to be a divergence there. We'll sell at the high end because we don't need to have stabilized properties, but we're going to sell at a price that really makes sense for us to go reinvest at the low end, kind of the distress stuff, and make the gain that is required. But I think that part of that, and I think smaller investors forget this a lot. If I'm doing work, I need to get paid for my time. That's very different than me putting money in something and getting paid for my money. Mm-hmm. So we have a private lending arm, and people do flips and stuff with private money. Well, they'll take a couple $100,000 of their own, borrow money from us, and go to a project, and they'll be a contractor, and they will work on that job and come back and say, hey, we made $50,000. Well, okay, it's fine for us. It's like, we're in good shape, we're the lender, but did you really make $50,000 return on your investment, or did you make $50,000 return on your time because you weren't out building a house for somebody or weren't out doing tenant improvements that you would have been getting paid for? And so there's, I think that we have to differentiate those different aspects in our mind.
One of the challenges we have here, and I know this is nationally because we have a international audience, is like I'm working on a development project right now for a national tenant, and I'm representing the seller, selling the land, and it's not even at a premium price, but the tenant is not willing to pay enough rent to cover the cost of the land. And we just got an estimate on a build to suit. It was $1,100 a square foot.
I hope that's a retail tenant or like a data
retail
center.
tenant. And so what happens though is there's that pressure. There's the people that want to get the premium, like you're talking about, for their project. And then there's the pressure from developers because they can only pay so much for the land and so much for the build to make it all pencil out. And there is a gap, and that gap is significant enough to, some of the brokers in the area that I work with that are purely on the development side, they're not able to bring those two pieces together. And so what are your thoughts on that? Because you guys do you build properties from the ground up as well as purchase existing assets?
So whether we're purchasing something or we're building it, if it has any sort of value add, one of the big things we're looking at is what's the difference in our yield on cost. So what is the rents versus our cost?
Yes.
Versus what is the market cap rate. So a yield on cost is basically your stabilized cap rate versus the market cap. That difference is your profit margin. So if in your case, if the total costs are $1,100 a foot, if I wanted a 10 cap in my pocket, a 10% return, if I was paying cash for it all, I would have to get $110 a foot per month, per year. That's a lot for a tenant to pay, right? $10 a month or nine something a month.
And we're right around there, 130, 140. But the project costs, for example, on this one, call for $175 per square foot per year.
Yeah, for rent. So when you have that, it's like, that's really tough on the tenant. So the tenant says no, the builder can't build, and projects grind to a halt.
Yes.
We have a fund we're raising right now, and it's we have a kind of a 3-pronged approach. And one of them is new construction. And we get people that say, well, that's crazy. Why would you be building right now? And the truth is, it's really, really hard to build, which means no one's building, which means that if you can get a project done in the year or 2 years from now when it's done, you're the only game in town.
That's right.
And so it's tough because you have to get your returns there with the higher interest rate, with the higher cost, and rents that have not yet adjusted. to those higher costs. So it's kind of like the needle in the haystack, but when it happens, it can be great for us as a sponsor and for our investors in those projects.
Yeah, it's beautiful when you can make it happen. Like you said, there's so many development deals that I've been working on that fall apart because of exactly what we're talking about, how that the cost, the spread of the cost, profit versus end user.
Well, and I think too, with some of these national brands, I mean, I'm working on 2 separate projects right now where the same exact thing's going on. You know, the cost to do this is way more than what the lease rates are per square foot. And the tenant needs to expand. The tenant wants to be in our market. The tenant is paying $23 more a square foot than they've ever paid anywhere to be in Louisville, Kentucky, guys. Think about that.
Louisville's pretty nice.
I mean, you know, we're moving on up in the world, but literally, you know, when they've got that plan, you know, they've had this plan. They've had this plan for probably 5 years. And now they're just now getting around to it because every site they wanted needed to go through some sort of redevelopment, rezoning, this, that. And that takes a ton of time. And, you know, let's be honest, a lot of the expensive costs that are up front are from the government that, you know, everything costs more when you're trying to site develop. Everything costs more. It's insane, you know, but that's where, you know, you're right, Forrest, because if you're the only game in town, then the next grocery or the next service or the next industry, you know, there's nothing for them to even come in and do. And so these brands are taking the risk now and paying those extra costs because they know 3 years from now, it's going to adjust up anyway.
No, totally. And we're not in a recession, at least not officially. And so if you're a retailer or a wholesaler or anything, the stock market wants you to grow.
Yeah.
Like that's part of the thing is you have to grow if you want your stock price to go up. And same store sales can be part of it. But generally speaking, all those companies are growing their space as well. And you have to pay for it. I mean, we have an Amazon build to suit right now. It's in California. And our cost just came back way higher than what we were anticipating. And the question was, well, is Amazon going to sign off on this? And then it's like, well, what other choice do they have?
Yeah, exactly. Because if your costs are that high, so is the next guy's.
Yeah, exactly.
Very cool.
Yeah, it's really interesting. And nationally, retail spending is up anyway. So I absolutely agree with you about the state of our economy right now. And so Forrest, you also have a fund that you're working on raising capital for. Do you want to talk to our audience about your fund, your product?
Yeah, I'd love to, of course. But fun fact for you first.
Break it down for us.
Do you know what the national vacancy is in retail right now?
It's like 11%.
No, it's like 3 or 4, isn't it?
It's the lowest it's ever been, ever. Do you remember 10 years ago, retail was dead? What happened? Retail was going to be dead.
Exactly.
3%?
I think it's like 3-4%.
It's between 3 and 4. I saw that the other day, and I actually looked at it twice because, you know, what they don't take into consideration in that report is shopping malls, right? Yeah. That's not, I mean, even though it's retail, they did remove those. So, you know, the shopping malls aren't taken into consideration on that for whatever reason.
But I think it's a good reminder that the future doesn't necessarily look like what we think it's going to look like. Mm-hmm. And, you know, we don't love office. I mentioned that earlier, but looking at office, everyone's so down on office. There are going to be people that crush it on office. You know, there are buyers buying office space right now at 20, 30, 40% of replacement cost. And those costs aren't going down over time. So when and if demand recovers, they're going to do really, really well.
And I agree with you on that, Forrest. I think the reason why people aren't taking those risks now and buying them is because they can't afford to hold them while they sit empty.
Absolutely.
You know?
Absolutely.
And I mean, that's one of the things where Louisville is we're not moving on up. We are moving on down. It's our downtown center that has high rise after high rise where massive companies have just announced one right after the other within weeks of each other that they're vacating downtown. They want to be in suburbia. They want to be where the people are. They don't want, they don't need all. So what I think, that's what the solve's going to have to be for is these large high rises, because companies will go back to the office, but they've all figured out how to operate in way less space.
And in the suburbs, to your point, if you look at nice suburban office,
they sell just like that.
Strong.
Yeah.
So I totally agree. And the difficulty with those high rises, there's a lot of people trying to do conversions to residential, but when you have a large floor plate, residential becomes really, really difficult because you have to have egress and you can't have an interior residential unit.
No.
So it's going to be interesting to see what people decide to do with those buildings. We have no desire to play in that space. It's not us. We're okay building. We do not like to develop or redevelop. Partially, I shouldn't say partially, but a lot of it's those scars from 2007. 2008, just dealing with governments. And I'm fine if I understand risk. I can quantify risk, but uncertainty is just, how do I tell an investor we think we can get these kind of returns if I don't know it's going to take me a year to get approvals? Or we just had a hotel we came in on that the developer had 9 years to get approvals for this hotel. We came in after the approvals were in place, but 9 years, that's crazy. So we don't want anything to do with that. But there's going to be people that will do well with it. It's just not going to be us.
Yeah.
I was just in a CCIM class a couple of weeks ago, and the instructor, he 100% invests in office, and they're able to hold some of their buildings, but they've also done some redevelopment projects. And they're doing very well, and they're buying some large floor plate, large office buildings. So it's just interesting to me to talk to investors and developers and the different facets of commercial real estate and how they approach it and what their strategy is, because it's not one size fits all, obviously, as you know. And,
Lisa Marie, did he say what market they're doing that in? I'm just curious of the area.
I know that they have developments all over the place, but I don't know what they're specific. He's actually based out of Texas.
Okay, I have heard Texas office is doing well.
So they're just they're buying a lot, and I think in the long run, he said they have just a very positive projections for what they're doing, but they're also doing reuse on some of those buildings. So I guess they just depends on what you're comfortable with, what and what your financial position is. But so tell us about the fund, Forrest.
So we met the first time 10 years ago when we were doing what we called a multi-tenant income fund. One of our key kind of investment philosophies is we like lots of interchangeable tenants. So if you lose one, there's dozens to put back into it.
Yeah.
It doesn't mean we don't do the Amazon build-to-suit. The opportunity's there. We like the opportunity, but that is a single tenant. And if Amazon went out of business halfway through construction, that project's hosed. Where if I'm doing a multi-tenant, like an office warehouse project or multifamily, one tenant leaves, I don't even know that tenant's left because there's thousands behind them. So we like multi-tenant, and that fund we did 10 years ago was around that.
Yeah. I wish you would have bought that property. You'd be killing it right now.
Yeah, I know.
Because of its proximity to the Tahoe Reno Industrial Center, the world's largest industrial park, and that apartment complex that we looked at was individually had individual APN, so they could have been sold as condos. So I guess hindsight, but those are the circumstances around which we met, was taking a look at that particular property.
Yeah, it's easy to kick ourselves over deals that we missed. But we don't do the same thing when we find out the deal cratered, without us. So
yeah.
Overall, I guess we can be that fund, by the way, has done unbelievably well. So it was a closed fund. investors could leave after 5 years, and then every 2 years thereafter. We've only had one investor in that fund leave, and they needed funding for a business they were starting. And so they're investing some other stuff with us still. Through the end of last year, I've not gotten the updated numbers yet. The investors had a 30% IRR if we were to liquidate at the end of 22, I guess it was. And that's a 9-year, 30% IRR. That is crazy. We're distributions are 20% a year right now. So time, you get in, you get things stabilized, you put good debt, and over time, it builds. And so that fund is still going. After that fund, we didn't do really any more funds up till recently. The market changed. It was hard to say this is going to be our singular strategy. We were more looking for things it was more like just looking under rocks until you found something that made sense. So we were doing all single purpose entities and putting together our investor groups depending on what it was and what people's preferences were. About this time last year, maybe a little earlier, we said, you know what, we are going back into a distressed real estate market. When there's times of distress, we have to be able to move quickly. We have to be able to be 100% sure we're going to close. We need to know what we're looking for. And we need to be able to say no 20, 30 times quickly. But when we say yes, we have to go all in. So whether you call it being conservatively aggressive or aggressively conservative, I can't figure out which way to go with that. But that's what we have to do. No, 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 no. Yes, we're all in. And to do that, we need to have discretionary funds in hand. So we went to our investors and said, this is our thesis on what's happening in the market. If we could build a fund that would be perfect for you, what would it be? And the feedback was, we like some income. It doesn't have to be a ton, but if we're taking money out of the bank, we want at least to replicate the bank. So let's call it 3, 4, 5% right now. But we also, if we're going to not have a ton of income, we like pretty good upside. So we structured the fund with kind of 3 basic, strategies, focuses. One is private debt and non-performing loans. So private debt right now, we're getting anywhere from 10.5% to 14% on first deeds of trust. And oftentimes those are below 50% loan to value. Our belief is if we can look at the piece of property and say, I would love to own that property at the debt amount, then it's great collateral for what we're loaning on it. And we're getting paid to potentially take collateral back in the future. Knock on wood, we have never taken a property back in my entire career, I don't think. We've done some workouts where we took it back through an agreement, but we've never had to go through foreclosure, take a property back. And so we're getting paid anywhere 10, 11, 12, 13, 14% there. The non-performing notes, much higher. We're expecting 20% plus IRR on those. They're a lot more work on our part. They don't have consistent income, but you're still in a first position. They're still really good collateral. The second focus, which I mentioned earlier, is the new construction when we can find projects that make sense. This Amazon build-to-suit. We can tie in our returns from the very beginning because it's part of the contract. Cap rates can change. That's still a risk. Interest rates, depending how we do the loan, could change. That's still a risk. But we know what our revenue is going to be kind of out of the gate. And because it's a triple net lease, we know what our NOI is. Mm-hmm. In those cases, so we're the general partner, and I don't mean that in a legal term, but more of an industry kind of like it's our job to run the project. There's limited partners, they're passive. Limited partners come in. For the fund, all of our general partner compensation, which is the promote or the carried interest, is going into the fund. So on those projects, we are underwriting our hurdle to 30% IRR for the fund returns. The third prong is distressed property. We have a property in contract in Mississippi. It's an industrial deal. It's not a nice property. I'm not going to pretend that this is Class A industrial, but we're in contract at $12 a foot and have 25 acres more to build on top.
Oh, wow, that's nice.
It's great. Like there's a fenced yard there that we think we can get between $2,500 and $3,000 an acre for truck parking. And it's 6 acres of the 25. That's $180,000. Is that right? My math? Yeah, $180,000 ish a $50,000 a year. That's not even part of the buildings. Like that's just
Right.
land that we can lease out. So that goes back to the intrinsic value and the distress.
Yeah.
The tenant moved out. They left the property in horrible condition. The owner is like, I can't deal with this. I want cash. Get me out. Now, not included in our pro formas for the fund, but I think we're getting into like inside baseball here, so it's a little more complicated. But if you take a distressed deal where at a deal level, you're going to get 30, 40, 50% returns, and you put a GP-LP structure on it, so now the GP is getting a promote on top of it, which that's the fund. The fund as the GP in this distressed deal could be getting 40, 50, 60% IRR. That didn't exist in anybody's imagination other than, occasional development that went right or something 4 years ago. So the opportunities that are in front of us are outstanding. When we did our pro forma and when we did all our slide decks and all our projections and everything else, we went back and changed the returns down because they didn't look feasible. Like people would look at it and say, you guys must be a Ponzi scheme because
ludicrous,
it's
right?
Crazy. But for all of those of us that went through 2008 and 2009 and 10, like everything was on sale.
It was.
And when things are on sale, well, I mean, I'll use that example of the property that we're upside down on. The buyer knows our back's against the wall. They know we're upside down. They just came back and asked for a 8% price reduction the day of contingency removal without a good excuse because they knew we needed to sell.
Mm-hmm.
It is a buyer's market right now. I'm really frustrated about that as the seller, but I know that there's going to be other sellers that need us like this deal in Mississippi. And, we didn't squeeze them. We're not going back for a price reduction or anything. We told them where it would work for us. We came to an agreement. We're doing it. And there's a lot of opportunities like that out there. I do think, though, that there needs to be a differentiator here. If you look at the big companies, Blackstone, KKR, these big companies, they have distress as well. They have loans expiring. They've also built up these massive distress funds. They're not putting money out yet. And there's kind of conversation saying, well, there's not going to be distress because there's all this money. And to a certain degree, that may be true. But if you think about it being financial distress, if you're a big investor, you can solve your own financial distress.
Right.
Now, on the other end of the spectrum, you have your local investors who all sign personal guarantees with the banks they bank with. They cannot afford not to solve their personal distress. In between that, and I don't have an exact number, let's call it $5 million purchase price to $50 million purchase price. Somewhere in there is where a lot of those syndicators we talked about played. There are people that have maybe a ton of investors in a project. When they go upside down, how do they recapitalize? So if you're a sponsor, and let's say you're 10% in a deal that has $20 million of equity in it, and you have 100 investors, which sounds crazy to us, but there's a lot of groups that had 100, 200, 500 investors in a single deal. How are you going to get them all to agree on how to recapitalize that deal? And that's where we're seeing the opportunity. It's that it's like if you were talking about companies with revenue, you'd call it that middle market type deal size. We're not opposed to doing bigger stuff. Like if it's there, we'll absolutely do it. But our real focus is kind of sub $50 million because we think it's too small for the big distress funds to play in. If you're Blackstone, your overhead is such you cannot afford to do a $30, $40 million deal. We can. We're a small company.
Mm-hmm. So what are the requirements on this fund? What are the type of people and who are you looking for?
It's a good question. I'm going to answer a couple different ways. Because one is like, well, what does someone's balance sheet or availability to invest look like? The fund has a $200,000 minimum, but really we like investors that are investing more than that, but $200,000 there. So obviously that's being an accredited investor. But more important to us is the philosophy of the investor. We only want investors that are in alignment with our philosophy in investing. And so it doesn't mean that they have to be 100% in alignment. I mean, some investors have different pockets. they can be like buying Bitcoin in one pocket and buying treasuries in another pocket, two different pockets, two different philosophies. That's fine. If they have a pocket that fits our philosophy, great. Value oriented. We want to be able to hold everything forever if we need to. We don't necessarily hold everything forever. I mean, we'll sell if someone gives us a good enough offer, but we want to be able to say, I like this asset and I like the return profile and I'll put long-term debt on it. Again, I don't want to get stuck in this interest rate craziness in the future, which, people say, well, it hasn't happened for 30 years. Once this is over, it's not going to happen for 30 years again. We don't know that. And so we like to be able to be stable. We want a stable portfolio focused on cash flow.
One of the things that I like about you, Forrest, and about working with your company is that you are very clear about what your goals are and you can easily articulate those, even though they may change over time and with the market and with the trends. When we asked you earlier about your three-pronged approach, that makes it, it may be kicking a lot of rocks or needle in a haystack, but you also know exactly what your philosophy is. And that makes it easier for you to attract that ideal investor because you're very clear about what you want and what you need. And it makes it easier for you to connect with the people that want to do business with you. What do you think?
And I'm very proud of one stat, I would say, for our company. I can't say that we always hit home runs. Sometimes we don't even try. We often try to hit singles. A lot of our projects, we went into them knowing it's only going to be a 14, 15% deal level IRR. But on a risk-adjusted return, we thought it was a great return, so we did the project. But the one stat that we point to a lot is we have a 93% reinvestment rate. And oftentimes, that other 7% just hasn't reinvested yet. And so, that's our goal, is to have every investor that works with us think that we are the best investment experience they've ever had. So it doesn't mean we're going to chase the highest returns. Sometimes we'll get them, sometimes we won't. But we want them to feel like they're being heard, they're being taken care of, they're getting all the information they want on a consistent basis, and they know what's going on, whether it be good, bad, or ugly.
That's a significant statistic that you have of 93% reinvestment. And like you said, some of those people may be in their 2 years, before they reinvest, they're staggered or whatever. But that's pretty fabulous. Not everybody can say that. What do you think about that number, Stephanie?
No, I think that's impressive. Look, there's all kinds of people in the space that, are running, or say they do what you do, Forrest, right? I mean, there's all kinds of different things. And I think that it speaks for itself as to, how you've protected your investors, which is why they keep coming back to you, right? I mean, you all are on that conservative side of things and not taking every risky opportunity that exists out there.
Yeah, but again, I mean, we have our niche.
Mm-hmm.
We like our niche. We definitely want to focus on our investors in our niche, but there's a lot of good real estate companies.
Yeah.
Real estate is such a massive part of the economy.
Yeah.
Sometimes I hear like, well, how come you're helping that person? Aren't they your competitors? You guys are both buying apartments. I'm like, yeah, but how many apartment buildings is there in the country?
Yeah.
I mean, and then you open it up bigger to the world. Like, there's so much real estate that we don't really view people as our competitors necessarily. We just have different niches, and some people, everyone does business a little bit different. And as an investor, because I also invest with other companies at times. Right now, I'm doing everything into the fund. I'm very, very bullish on the fund, but I have in the past. As long as I'm in alignment with their strategy and the way that they treat their investors, they can do a great job. Altus cannot be everywhere at the same time doing all projects across all spectrums.
That's right.
It's impossible. So there's other people doing good jobs too.
Awesome.
Yeah, that's that saying that I like, which is if everyone's your customer, no one's your customer. So you focus on what you're good at and the people that you want to play ball with, and you've been able to roll with it and have some success. Really appreciate you sharing your story with us today, Forrest. Is there any parting words of wisdom that you'd like to share?
I think investors right now, the stock market's doing pretty well, so it's not as bad as it was in, say, 2009 and 10, where investors were really scared. But when investors are looking at real estate and they read the news, it's all bad. It's just constant bad news. I hope that anyone listening in that's an investor can read that bad news, and instead of saying, you know what, I need to stop doing real estate, they can instead think this is opportunity.
Yeah.
Because if Warren Buffett has said it many, many times. There's actually two quotes that are true right now. When the tide goes out, we find out who's not wearing any underwear. And the tide's going out on a lot of people. And then the second quote is, buy when there's blood in the streets. And it's early. There's going to be more blood, but there's blood in the streets right now, and there's opportunities out there right now. And if you can buy things at great intrinsic values and have a longer horizon, don't expect to make money in 6 months, 9 months. Expect to make money in 5 years, 10 years. The opportunities here.
Yeah,
Awesome.
that's really great advice. I appreciate that. I guess we'll find out who's wearing underwear and who's not.
We'll soundbite just that clip and we'll use that. I love that.
I wish I could take ownership of it, but that's Mr. Buffett.
Hey, you introduced it to us. I love it. So it's been awesome having you on today, Forrest. Thanks so much. Good getting to know you as well.
Good to see you, Forrest.
Next time in Louisville, I'm going to come see you.
You better.
Yeah, definitely.
I hope you and your family are doing well. And it was great. His daughter sat in on our business meeting that we had last month. It was really great to meet her. And I wish you the best with your new house. And we'll talk to you soon. Thanks for being here today.
Great. Thanks, Lisa Marie.
Bye, everyone.
Bye.